A 1 millisecond glitch inside an AI data center can instantly torch millions of dollars. This small company built a solution and the stock went up 700% within a year. Credo Technology Group, ticker CRDO, provides AI connectivity solutions, or to put it simple, cables. They developed the active electrical cable, which has quickly become the industry standard for short-range connectivity within data centers. Think about the architecture. An AI data center consists of tens of thousands of superchips grouped in server racks. Naturally, these chips must be connected. When it comes to data center cabling, two things matter most: energy consumption and stable connections. If there is a link flap, meaning a short interruption in the connection, the entire AI training process can crash. When that happens, hyperscalers lose millions of dollars instantly. Credo's copper cables solve both problems at the same time. Their cables consume 50% less energy than optical alternatives, while improving reliability 1,000 times by utilizing their zero-flap technology. Credo's primary competitive advantage is simple. They're the first mover, and their R&D team is years ahead of the competition. Their processing chips use mixed signal architecture. This cuts manufacturing cost while lowering the overall risk for hyperscalers. These cables run on Pilot, Credo's proprietary platform that is already deeply embedded in customer workflows. Pilot runs the zero-flap checks, stopping potential interruptions before they happen. This creates massive switching costs. Switching cables in a multi-billion-dollar data center is not like unplugging the HDMI cable on your TV. These massive server racks are engineered from day one around Credo-specific cable design. Once a customer is locked in, leaving is incredibly painful. On top of that, Credo holds a wall of patents that prevents competitors from copying their technology. This moat has already secured high-margin licensing deals with industry giants like 3M and the Siemens company. Now let's open Stock Picker to check the core fundamentals. The revenue has been growing exponentially. Reports show Credo has locked in all four major hyperscalers alongside SpaceX and the rising neoclouds. Apparently, everyone wants to leverage their zero-flap technology. Their revenue last quarter hit $437 million compared to $170 million for the same period last year. That's an impressive 157% increase. To put that into perspective, in just one quarter, they generated the exact same revenue they made during the entire fiscal year of 2025. If we look at the future forecasts, analysts expect this hypergrowth to continue, projecting $6 billion in revenue for 2031. But we should never blindly trust analyst models. Wall Street simply follows the prevailing market sentiment. And right now, the sentiment around most semiconductor stocks is incredibly positive. Credo's gross margin last quarter stayed at 68%, which shows their pricing power. This is a major indicator that we want to check here. If it starts dropping, it means their moat might be in danger. We can also see that now that Credo is generating more money, they have decided to increase their budgets for research and development as we move to higher speed connectivity. This transition is the single biggest risk for Credo stock. Think about the cables like highways between processors. So far, the speed was 800 gigabits per second, meaning 8 lanes by 112 gigabits. Their copper cables could connect chips inside a single rack and easily bridge different racks up to 7 meters apart. But the game is changing. The current transition from 800G to 1.6 terabits per second requires 8 lanes running at 200 gigabits. And this is where copper hits a hard physical limit. Active electrical cables are still the best option inside a single server rack. But for rack-to-rack connections longer than 3 meters, copper becomes completely obsolete. They need to use optics. And optics is Marvell Technologies' game. Marvell is aggressively deploying capital here alongside their acquisition of Celestial AI. To fight back, Credo is acquiring smaller players using their $1.4 billion in cash. They just bought Dust Photonics to force their way into silicon photonics. This vertical integration is designed to protect their high gross margins. Credo doesn't need to dominate optics to survive. Hyperscalers want a third option to break up the current Marvell and Broadcom duopoly. Credo is diluting shareholders through stock-based compensation, acquisitions, and corporate warrants. They had a deal with Amazon, allowing them to buy 4.1 million shares of Credo at $10.74 per share. Amazon reached their milestone and vested all those shares. Also, the Dust Photonics acquisition is for $750 million in cash, plus a potential payout of 920,000 shares. Credo's shares outstanding moved up from 163 million to 184 million over 2 years, which is a 12% dilution. The stock is now priced for perfection, with its price to sales multiple climbing to 34x. This valuation assumes that growth will continue at a similar pace, but we also have to consider the concentration risk. The majority of Credo's revenue is coming from hyperscalers. If one of them decides to switch vendors, it would be a major hit to Credo's growth. Full disclosure, I held a position in Credo, but because of this valuation and the looming optical transition, I decided to take my profits and walk away last month. Credo is a rare example of a company where the hyper-growth is completely real, but even high-quality businesses have a price where the math no longer works in your favor. In this playlist right here, we run the exact same structural analysis on other companies, tearing down their business models, competitive moats, and financial growth to see if their actual story justifies the market price.